Hey everyone, apologies for the late start, but looks like we've got quite a few people online already. Yes, cool. All right, well, welcome to this morning's webinar, all about how to structure property development. I might sort of do a brief introduction before we get into it, but yeah, it looks like we have a fraction over 50 people joining this morning, which is yeah, that's an awesome response. So it must be a bit of a topical presentation to speak on. Before we do get into it though, I just want to mention that we are also open to questions throughout the webinar. Now the best place to do that is, yes, there's a chat box there, but I'd prefer to use the Q&A button. So, so you can type a question in there and then we can manage the questions a little bit better, which is pretty cool. So if you do have a question, just pop it in the Q&A box. And yeah, in terms of what we're going to cover today, we are going to cover a few different topics, but one of them is going to be business or capital. So just sort of working out how we approach the development itself and what that means as a flow-on effect, because that's kind of the most important question to start with, and then everything else we can work out from there. The next one is funding the development. So, so if you do need access to cash to complete your development, what are the options there, which is pretty exciting. And then that third topic there, tax on tax on tax. So yeah, I think I've listed out at least 5 taxes to consider, and I'm sure there's more depending on which state you're in, but yeah, an obscene amount of taxes to run through. And then I'll finish up with some example structures, and that's where I think we're going to spend most of our time, which is going through some examples. And then I'm guessing that's where a lot of the Q&A might come from, is, you know, how do we approach it if we've got this scenario? And I might just say that no one development that we've done structures for has been the same. So we've got some foundational structures that we use, which I'll share with you this afternoon. Oh, sorry, this morning, but later in the webinar. But what we do is usually piece a few together to get an outcome. So pretty cool. And yeah, hi Vivian, nice to see you on the webinar this morning. Awesome. So a bit of an introduction to me. I've got personally a massive interest in property. I've got friends who are developers, who develop. We've got builders who, you know, do their own specky homes and things like that. And I guess yeah, I've seen sort of many different forms of development, including obviously helping out with the structuring behind it. It's pretty complex, but you know, the rewards for the developer are usually pretty significant, especially when you've got an edge, you know, such as being a builder, where, you know, you essentially can get to a point where you may not need clients because you are your own client and you continue sort of building and growing your family's wealth through that method. So all sort of different structures, but it's pretty cool. Yeah, in terms of the SMSF side, so usually with property development, in fact, I think most of the developments we structure in some form use superannuation to fund the project. So in terms of SMSF, I've been an SMSF member myself. That looks like for close to 10 years now. We've worked with hundreds of SMSFs since 2007. We've seen compliant and non-compliant, weird and wonderful investments. We've owned a business through SMSF, and yeah, I guess the gross wealth is around about 130 mil for what we look after. So, so that's I guess, yeah, in terms of like the two sort of specialist topics is SMSF stuff, which I love, and you combine that with property development, and I love it. So what I'm not though, and I think it's important to mention a few of these points. So I'm not a financial advisor, nor am I going to comment on the business model of property development. So that's, you know, if you're looking to make this investment, usually clients who do this, again, have some sort of understanding of property, whether they're, you know, builders, architects, you know, they might even be engineers, to do with property, but and they've got the expertise to run it. We're approaching it from a, all right, here's what we want to do, how do we structure it perspective. So I'm not going to go and tell you to develop property as an example, nor is this the advice that you need. So giving you specific advice as well, like I might do Q&A, but you've got to understand that this is pretty limited in terms of the context I've got in your question. So don't run off and just act on that. It's so important with this stuff, given how complex it is, that you do get detailed advice around it. Yep, not going to tell you when to invest in certain classes of assets or certain investments, and I'm not going to give you enough information so that you can go and wing it. So again, you've got to work with advisors when you're doing this sort of thing, that have done it, know what they're doing, because if you balls it up, pardon the expression, then yeah, that can mean a monster for tax or non-compliance of superannuation, all sorts of things that we do want to avoid. So, so please keep that in mind. So in terms of what I am referring to when I say property development, I mean, this is probably not an exhaustive list, but things that we've sort of helped out with are things like battle axe blocks, you know, basically drawing a line down the backyard and developing the backyard, whether you build a house or whatever. Splitter blocks, we've done knockdown rebuild, duplex, townhouse, apartments, land subdivisions, specky homes. But what I'm kind of not referring to in this webinar is just your sort of standard rental properties. So the law around that stuff is so much less intense. So what I'm focusing on is almost the business of property development, rather than, you know, buying a house and renting it out. So I hope that is why you're here. So in terms of the topics, my first one is, and this is really a fork in the road for where to from here, is what type of development are you doing, and is it business or capital? Now, in this sort of stuff is also, how do I say it? It's not black and white when it comes to legislation. There's a lot of case law that supports arguments either way for this thing. Now, unfortunately, you get a, what's the word? You get a worse tax outcome with business, but that's what's going to be most developers. Most property developers are going to be seen as people running businesses, not just, and I'll go through capital in a sec, but you will be taxed in most cases on an income tax perspective, and because property or you know, the sale of a house or any sort of business, we've got to consider goods and services tax like GST. It can actually be a big chunk of your intended profit. Yeah, but I would say, you know, there's very rare cases where we would say a property development is on a capital basis, where I think that the words that they use is a mere realization of an asset. Now, some examples where your development might be on capital is where you've owned a family home for a number of years. You've got a fairly big backyard. It might even be a battle axe block, or you might be able to get a driveway down the side of your house. And what you're doing is you do want to sell either the backyard or the whole thing. But before you do that, because you want to be savvy about it and I guess make some money on the way out, you know, you approach council, subdivide the backyard, and up to you whether you build on that, but you know, even sell the block of land at the back separate to your own home. Now, you know, we need to look at so many things around that, but that could be a situation where we can look on a capital basis, where the tax outcome is a bit better. You know, where you might even get a 50% discount from a capital gains tax perspective. But some other things as well is, you know, with capital, you're kind of stuck in the structure that you've owned it in. So, you know, so if it's the family home, for instance, you might own that in a personal name. And, you know, we need to look at the tax outcome of that, which, you know, as an individual, the highest rate of tax is, you know, 47%, or, you know, depending on HEX and all that sort of thing, it could even be higher as well. So, yeah, and in terms of capital as well, the sort of final thing I'd say is don't play with fire. You know, if the ATO go and review, if you've decided whatever the thing is capital with you and your advisors, and it turns out that it's income tax, it's a business rather than just a mere realization of an asset, that's not going to end well from an ATO perspective. So yeah, and we've had some we've had some clients where you could argue either way with that, and we've got to go in the detail, you know, look at each scenario, you know, even get advice from sort of people who can comment around the case law, so even tax lawyers, depending on the situation. So anyway, this is kind of the biggest question. Some of you, if you don't own a property currently, then this isn't even a conversation we'd have, because if you're looking to buy a property, develop it, and then sell whatever you produce, yeah, that's and do that rather quickly, that's for sure going to be looked at as a business or on an income tax basis rather than a capital. So yeah, I guess that's the sort of first thing to cover. Now, in terms of funding the development, you know, this varies from client to client, and you know, I guess the easiest of it all would be if a client is self-funded. But because of the cost of the purchase of potentially a block of land or a purchase of a site, and then the construction on top of that, usually, and I think there's a very small handful of cases that are self-funded, but usually someone needs funding from either banks, where they can sort of lend money from that perspective, or what we've seen is using the help of superannuation. So what I'm going to be doing later is giving you some structures where you know, we have helped clients access superannuation, whether it's their own or they've almost got like a bit of a syndicate with friends that they know of who can go in with them. So so there are some scenarios I'll go through. Bank funding, again, depending on your structure, bank funding is a little bit less complex in most cases than funding through super or using part of super, you know, where you basically just apply to the bank for a loan. And again, it depends on what you're funding. If you're funding the property purchase, that's a lot simpler than going to fund the development itself. So getting development finance, which is usually higher rates of interest, usually a few more hoops to jump through, and they will lend you less as a LVR than if you're going to buy a standard property from the bank or just a rental property. So yeah, just something to consider there. But yeah, they're the kind of three sort of funding points I see. So whether you've got all the cash you need in a bank already to carry out the development, or you need access to superannuation or bank finance or developer finance. So they're kind of the three different ways. Now, the next topic is to chat through the tax impacts, and at a high level, you know, I say tax on tax on tax. It does seem like it never ends, unfortunately. But here's some sort of 5 high-level things we need to think about as accountants when we're approaching the structure of how do we carry out this development with a client. So the first one is income tax. Like, how does that play out? And I guess on a high level there, you know, if you buy it in a personal name, then you're looking at upwards of 47% tax, depending on the structure that you, depending on your marginal tax rates. Then you've got structuring through a company, which again, depending on the setup, you might pay 26% tax if you're classed as a business, or 30% tax if it's a bucket company or it's seen as investment income. And then if you structure as a trust, which in basically every example I've given that I'll run you through, you actually choose who gets, at the end of the day, who gets the profit of the development. So yeah, and income tax is usually, you know, obviously if it's a profitable development, which I hope it is, it can be one of your biggest taxes. So getting that right is critical, and that relies heavily on your structure. Now, actually, I've got a slide for each of these. Income tax will be payable on developments that aren't capital. And again, just from earlier in the webinar, that's most developments will be on an income tax basis. So choose your structure wisely: company, trust, individual name. That's the conversation we have to have there. Now, CGT will be payable on developments that are capital. So again, very small percentage. It might be that backyard that you're subdividing and selling. And we can apportion main residence, that's incorrect spelling, exemption. So the main residence exemption. So the calculation to apportion a gain when you subdivide your backyard is pretty intense, but again, as I said, it's a bit more favourable tax outcome if it's considered capital in nature. GST. So GST will be payable on developments that aren't capital. So again, most developments you'll pay GST on your sale when you go to sell whatever you're selling. If the developer doesn't rent it out, so if you develop something and you're going to hold it long term, then you may be able to avoid paying CGT when you eventually sell it. Now, the length of time to hold that property is not crystal clear in legislation. It's in case law. And, I've seen things like roughly 5 years to rent out an asset before you sell it, where it's considered a rental property rather than you're selling stock that you've built. So yeah, so again, you don't want to play around with this stuff. You don't want to say, oh yeah, I've rented it out for 6 months to avoid GST. It just doesn't work like that. So so GST might be a necessary evil in a way. Now, there is a bit of saving grace there. If you've purchased your land or your site and it's had GST on it, then you may be able to claim that GST on your purchase. But also, I'm not sure if people watching have heard of the margin scheme. Again, it's a very complex area, but the margin scheme says that, a lot of pages of legislation, it basically says you pay GST on your profit rather than on the sale price. And that's for benefit if you've acquired a site that you haven't paid GST on. So let's say you paid $2 million for a block of land, and you can't claim GST because it wasn't a GST supply. Then the margin scheme, if you can apply it, allows you to just pay the GST on the profit, which is pretty exciting, than paying full whack on your sale price. So again, pretty complex. Stamp duty. Stamp duty is a state-based tax, and it's paid on the purchase of your site. Now, keep in mind as well, your buyer. So once you develop your property and sell that to the buyer will need to consider stamp duty as well. And again, state-based, it's different amounts. In fact, I think New South Wales has recently gotten rid of it for certain purchases, which is pretty exciting. But yeah, one to consider and factor into a feasibility. All of these are, by the way, you need to work out before you get into it, ideally, what your tax impact is and how that plays out in your feasibility. And then the last one is land tax. So state-based again, but in Queensland at 30 June, the OSR or whatever the person who looks after titles is, they'll take a snapshot of who owns what property at 30 June, and they'll send you a nice little land tax bill. So that can also come into play when you're looking to sell blocks, and selling them before 30 June in a year might mean the difference between paying land tax on that block or not. So keep in mind when you go and register if you're doing land, for instance, when you go and register your title on that land, if you own that at 30 June, bang, you'll get a nasty bill versus probably the block before it was developed would be a lot less land value per square metre. So again, keep in mind land tax. Tax on tax on tax. Alrighty. So I've just got a question come through. So I have subdivided a property and got DA approval for the back block. I'm living at the front for over 18 months. Will I get CGT exemption? Again, that you could, but that is something where we would want to do specific advice on and get more context around that, around the situation there. I mean, it doesn't look like, you know, you've done a DA there, you've lived in it for 18 months. I mean, it doesn't sound out of the question from a capital perspective, but again, you don't want to wing that stuff. So yeah, I'd recommend getting some specific advice on that one. I've got another question. I purchased a property under a company structure. What structure I should have for the construction of the development? So, so in terms of the structure, once you've purchased a property, it's usually that whoever holds the land will become the seller once you develop it. So if you buy a block of land in a company, develop it, the company will still own those blocks of land at the end of it. So really, that's your development entity. So you've really got to get that right, the right structure before you purchase the land or the site. Rather than, you know, if you do want to change it, you've got to consider stamp duty as well. Even if you're selling it to a related entity, you know, at least in Queensland, what do they call themselves? Office of State Revenue still takes a chunk out for stamp duty. So yeah, so you need to make sure that it is the right structure. And sometimes, like, we have had clients where we actually change the structure of the who owns the block or the site for various reasons, but one of them may be that it could be a better tax outcome. The company is the trustee of the trust who owns the land. So yeah, it sounds like you've got it in a trust, which may not be too bad, which is good. So yeah, companies, you know, we might want to use a company, but a trust again gives us that flexibility of where the profit goes on at the completion of the development. Alrighty. Another question: is it possible to hold a parcel of land in a family trust and set up a company for the development for asset protection? Again, I think, you know, I think it goes back to your seller of that land when the development is complete will be your trust. So I'm not sure from an asset protection perspective, you're still going to be selling to the purchaser from your family trust. So, you know, whether you chuck a construction entity in between to protect yourselves from the builders, maybe that could be possible, but you're still going to be, call it, in business with your family trust. I've got information to have another structure for the construction to roll over. Yeah, that might be a bigger question, Vivian. Sorry. Yeah, no, I think that might be a question just to better understand where you're going with that one. Cool. Alrighty. Well, actually, that's a nice segue into different structures. So we've talked about tax. Now I can still discuss tax with these structures, but I've kind of got some key points of each of these structures. So the first one we're going to start with, which is potentially like Eric's structure there, is development in a discretionary trust. So in a discretionary trust, it is very simple. Like it's not a very complex trust structure at all. But the limitations of a discretionary trust is that one family would be involved in the development, at least the entity that carries out. Yeah, I wouldn't, if someone's got two different families going into a development, I wouldn't be using a discretionary trust because you don't own a fixed entitlement to that trust. So so it's simple, but it's limited. You could access bank funding with a discretionary trust, and you can't use super, your own super anyway, to fund the project unless it's other parties. I guess if it's not your super, then you could explore getting a loan from someone's SMSF if they're a unrelated party. So yeah, discretionary trusts aren't
common for us because usually our developments will involve multiple different families, usually 2 or 3 or more. But occasionally we do have the odd one who we do discretionary trusts, and we can even do partnership of trusts. If you've got different brothers going in, or different brothers and sisters who are going in on the development, so they can have a split of that. So we have done partnership of discretionary trusts, but anyway, these are the kind of high level things to high level structures, and we can go more detailed from here. So another one is a simple unit trust. So again, nothing special about it. It allows multiple owners. There's not much restrictions. You can access bank funding, and I'll talk about accessing super in unit trusts in a sec. But again, quite a simple structure where you've got multiple families. This would make sense for. Next one is an ungeared trust. So this one isn't. It may or may not be perfect for your development or your property holding, but it does allow multiple owners, including super, even your own super. It allows holding an asset, so you can buy a property, but it cannot have a mortgage. So you cannot secure any debt on the property that you purchase, and that's the whole reason why it's called ungeared. So you cannot gear your property, which means you have to fund 100% of it, and that could be through your own money outside of super, or it could in some cases be superannuation that you use. But this type of trust, you cannot run a business. So this is the reason why we don't really use them for property developments, is because there's a chance that we could be considered running a business of property development. And if we do that, this structure then blows your super fund up. So we don't want to do that. But this is a structure where we might have, let's say a client has a bit of money in super, a bit of money outside of super, and they want to buy a residential or commercial property to rent out without using any bank funding. Now, this is a structure that we might use for that, for a sort of longer term buy and hold rental property. But a bit difficult to do, full on property development with it. Alrighty. Next one here. Now, this is actually probably one of our most common when we want to use superannuation. We call it an unrelated unit trust. So this one allows multiple owners, including SMSFs. So that could be, you could own part of this trust, this unrelated unit trust, with your own money outside of super, with a bit inside of super, but no one family that owns anything via super can control it. So again, when we're looking at the ownership, and we've got, let's say it's my super fund involved, me or my family's portion of this unrelated unit trust cannot exceed 50%, and I cannot be deemed to have control of that, of this unit trust either. That can be by legal agreement to have no control, but it can't mean I have influence over the other owners either, to a degree where I could control that thing. So it's a very helpful structure when you've got multiple families who want to carry out a development. But again, we need to make sure that if you are using super, we're not unintentionally breaching the superannuation rules. Now, this is one as well, and sorry, just with this one, you can access bank funding. So let's say you pool super, you've got 4 families with 250 grand each, and they pool $1 million together into this unit trust. Now, in most cases, that unit trust can then go and approach a bank for the purchase, or potentially development funding as well. So what this does is basically give you access to money in super that you may not have considered you've got access to otherwise. For instance, we did a it was actually four partners. Before Christmas, we did a property development structuring session with them. They hadn't really considered that they could use super, so we went through this sort of trust, show them they can pull about call it about $1 million as a plucking a figure. They've already got access to development funding and money outside of super as well. So their project size went from maybe a couple of mil or $1 to $2 million in terms of their first project, to now being able to think, well, hang on, we can actually do a larger project than we thought we could, because of the access to superannuation that we might be able to get there. And again, there's all sorts of compliance things to consider with every SMSF as an investor. And so again, you've got to make sure, if you're a trustee of a super fund, that you make sure this investment is allowable. You get the right paperwork in place, because again, if you balls up the investment from a super perspective, you don't want to be non-compliant, which can lead on to penalties and even in the absolute worst case, there's a 97% tax, not on the income of the fund, but on the assets. So it's pretty scary, but there is a way that the ATO can take 97% of your assets in your super fund, which is basically taking away your retirement. Pretty awful, but that's a penalty for huge disregard for the rules around super. So but again, used correctly and well, this stuff can make dreams happen that you might not have thought possible. Cool. Well, I'll just have a look at what I got next. So so that is actually what I had left for the structures. And again, we can get more complex than this. We've done developments where we put together an unrelated unit trust to provide finance for another development entity. So we've actually got two unrelated trusts. One's a funding entity, one's a development entity, and one lends money to the other. So so all sorts of combinations of this, or even the earlier trusts I mentioned. Now I did say that that I'm pretty limited in how deep I can go. There's 55 people now on the webinar, which means that I can't deep dive on everyone's structure. But if you do want to have a conversation around this property development stuff, we can start with what we call a strategy call at Inspire, and then sort of work out what you're doing, what sort of help you need, and then offer some next steps from there if that's what you want. But apart from that, I've kind of got up to the next 20 minutes to do some Q&A. So I hope that's been helpful, what I've shared so far. And yeah, just wanted to see where the questions go from here. Do you ever use straight companies with shareholders being discretionary trusts? I don't think we have ever done that, but it might suit in some circumstances. Yeah, Vivian, you strategy call. Cool. Actually, you might want to just reach out to Sakshi to book that one in. Yeah, just with Sakshi, her and me. That would be awesome because you're already a client of Inspire. Awesome. Thanks, Vivian. Cool. Well, there's not many questions. Yeah, Chris Hardy, how are you? Dan King, good to see. We've got a few clients on, a few accountants on even. G'day, Steve. Awesome. Well, hang on, I got a question. Do you assist in the feasibility of the development, and what do you generally use to conduct this? So we don't really do the feasibility itself, but as in, what's your budget for construction and all that sort of stuff. But what we can do is comment around the tax impact of it. So that's what we have helped out with feasibilities. Krishna has asked, what is the maximum number of unit holders we can have? That's really up to the trust deed. And actually, I think there is a maximum before you're starting to consider a managed investment trust, which I think is about 20. And depends on how much money you've got in that trust as well. But yeah, if you're starting to push over, let's say 5 to 10, if you're starting to push over that, then you'd want advice around what your maximum is. Are there any preferred trust structures for buy and hold investments? From Mark. Again, it depends on your priorities, and you can use any one of the structures we've used for a buy and hold. So you can use so jumping back a few slides, so you can use a discretionary trust, and when you've got a single family and buying a rental property, that's something we might want to consider. Unit trust. So yeah, you can buy an investment property in a unit trust. You can do it in an ungeared or a suit. So you can use all of these to buy a longer term investment property. Krishna has asked, do you assist in setting up managed investment schemes? If so, how much? No, we don't. So we don't specialize in that, but we can point you to someone who can. Unit trust has one corporate trustee director. That director owns only 10% unit capital. Abishek, I think that's because when I'm talking about unrelated unit trusts, usually we have a specific trust deed for that, and usually we would not have one director on that one. So yeah, you may be playing with fire if that's your situation as a single director in a unrelated unit trust. That director kind of has the power to call the shots, so not ideal. Well, that is the questions that have come through. Feel free to keep popping them through, but Rose has actually popped a link in the chat box for a strategy call. So that's just inspire.business/chat. Well, lots of questions. Yeah, do that director has controlling right? No, we don't want controlling directors with unrelated unit trusts. Generally, what would the situation be if a unit holder in a unit trust would like to sell their units? Again, what you would really want to do is get a shareholders and unit holders agreement before you chip in money. So get a lawyer to help with that sort of thing, which determines what happens when a unit holder wants to sell. So again, depends on the deed and depends on the unit holders agreement that you've signed there. But spend the money with the lawyers up front, not having a fight on the way out. Do you use multiple appointers for your development trusts? So that would be we don't usually have appointers with unit trusts because the unit holders would be sort of the controllers of that. So yeah, it sounds like a very specific question, so I'm not quite sure where you're going with it. Cool. Well, more. Cool. What do you believe is the minimum dollars to justify the cost of setting up an SMSF? There's no black and white number there. Depends on what you want to do with your super. And you also want to make sure it's not a silly financial decision. If you go and Google that question, you'll see numbers of around 200 to 250 grand. Again, that's not advice, but that's the kind of ballpark that that is relatively well known. Dev, what structure would you recommend for an investment group that is wanting to invest on an ongoing basis in property and there are new members being added every year? Wow. Again, this is probably a little bit too little context to answer with any specificness. I might make some comments around, usually when we're looking at developments, we might use a structure per development or per property rather than adding to it, adding developments into it. We might do that from asset protection perspectives, or because you want different unit holders or investors in each project. So yeah, but I'm not sure whether this is your situation, but let's say you've got a few family members who want to pool some money to buy a rental property, and then a few years later, after they're contributing another one, trusts might be something to consider there. But again, the other reason why we might want to do separate trusts as well, or separate things per project or per property, will also be land tax as well. So again, what we usually say to clients is, before you purchase a property or do a development, that's when you need to come and see us, even if you've already got a structure existing, and we'll either say, yep, that's still appropriate, or no, here's the reasons why you might need a different one. Vivian, about deferred tax. So I'm not sure what the question around deferred tax is with development. Again, that might be something we do in our phone call. Awesome. All right. Well, that is all the questions that have been asked so far. And I hope everyone has a fantastic Friday, but we might wrap up there. And thank you for spending about an hour or so on a Friday morning. And yeah, have a great weekend. Thanks, Eric. Thanks, Daniel. Thanks, Vivian.